morning, ladies and gentlemen. It's good going on Dalal Street. Fifth day of gains as far as markets are concerned. Everybody across the spectrum is gearing up for the final countdown as far as Bihar elections are concerned. The results will be out tomorrow morning by 10 a.m. But before that, everything is in top shape. Nifty up for the fifth day. 25,900 is back with the bulls. 26,000 is what is being aimed at. 280 points higher on the Nifty Bank. The IT index in a bit of a corrective mode. But all that could go right is going right as far as Dalal Street is concerned. And to discuss this and a lot more, we are joined by Mr. Sandip Bansal, Deputy Chief Investment Officer at one of the earliest PMS providers in our country, ASK Investment Managers. Namaskar, Sandip ji, and a very warm welcome. It's always a pleasure to welcome old friends, especially those who manage thousands and thousands of crore rupees. How do you see the markets at this point of time? Is all well, or could it have been better?
Namaskar, Shailendra ji. It's always a pleasure to speak to you and to be on your show. Thank you so much for having us. Yes, as of now, if you look at it, there seems to be triggers in place for the market. Results have been in line with expectations. Expectations themselves were muted. Because in this quarter there was the impact of US tariffs, GST, because of which there was demand postponement, plus excessive monsoons in a few areas. So earnings growth has been 5 to 6% in line. Corporate commentaries going forward is positive. So fundamentals seem fine. FY27 is likely to be a double-digit, low-teen kind of a growth for the market, low to mid-teen. From a liquidity perspective, FIIs, while they were selling till September, October they were back. So at least, there are signs of them again being interested in India, while domestic flows continue to be strong. As far as sentiments are concerned, there is news flow which suggests that the trade deal with the US, which is one of the key overhangs on the market, should be done in a month or two. Plus, as you said in your opening remarks on the exit polls, etc. So sentiments are also fine. The inflation print that came out again, was good. So yes, from a valuation perspective, markets are not really cheap. Because we are trading at about 21 times 1 year forward earnings, which is about the average of the historical levels. But if positive news flow comes through, earnings momentum picks up from the second half of the year, which is our expectation, then markets should be doing fine, possibly.
Right. Sandeep ji, we all have undergone a fairly strong bout of pain in the last 12 months or so, especially in the mid cap and the small cap space, which has been a favorite hunting ground for not only PMS fund managers such as you, but across the board, be it retail, be it institutional, be it ultra HNI, all have found a lot of pots of gold in the mid cap and the small cap space. However, the rally, especially this rally, is now largely blue chip, large cap, Nifty led stocks. Do you think a time will come when smalls and mids will also show signs of green shoots?
So that's a great question, Shailendra. As a basket, we are more positive on the large caps than the mid and small. Completely agree with you that the broad-based rally that we saw in the mid and small cap space overall might possibly be behind us. Now it is going to be more stock specific. Wherever we see a good earnings delivery coming through and the visibility of those earnings continuing are also high, those stocks will bounce back and will continue to do well. We've already seen that happening in this quarterly results. and our sense is that that is going to continue. So yes, the markets are going to become more selective, more choosy. The broad-based, broad-brushed rally that was happening all across the board is perhaps behind us in the mid and small cap space. But that is not to say that there aren't any opportunities out there. There are many businesses which will continue to do well, and we are just focused on selecting the right names.
Okay, fair point. Sandeep ji, what has been the broader philosophy of ASK Investment Managers as an overall strategy for the last 2.5, 4 months, where gold and silver has dominated the thought process for traders, for investors, and markets have been sideways? You think this phase will get over?
Shailendra, equities is a as an asset class is more productive in nature. Gold, while silver does have industrial uses, gold is more looked as a store of value, hedge for inflation, and in times of global uncertainty, uh, there is a flight that does happen to gold, especially in a scenario where we have seen central banks also increasingly allocating their reserves towards gold, and maybe somewhat away from US treasuries. So that could also be one of the reasons for gold to do well. There are phases which we've seen historically as well, when the yellow metal does significantly better than equities as an asset class. How long that phase is going to continue is also a function of how long the global uncertainty, etc., is going to last. As far as our style, our approach, our investment philosophy is concerned, we continue to remain entirely focused on Indian equities. We believe that as the economy increases significantly in size, as growth picks up, we will get plenty of opportunities in the country to identify and invest in strong businesses which will grow significantly over the next many years to come.
Okay. Sandeep ji, where have I'm sure you get hundreds of crore rupees as fresh funds in many of your PMS schemes. Broadly, over the last 6 odd months, what have you done? Have you bought into existing holdings to maybe average them lower? Have you added fresh blood in the mid cap, large cap space? What has been the broader philosophy? Buy what you have or add fresh?
So, we have added a lot of fresh positions as well. Largely speaking, what we have done over the last few months, Shailendra, is that we have increased the component of large caps in our portfolio. From a sectoral perspective, we have been bullish on the banking space, the private banking space, as well as the PSU banking space. We believe that the banking sector is overvalued given the growth prospects. We have already seen credit growth pick up to around 11.5% kind of levels. We believe that through the rest of the year and next year, the pickup should be good. Margins have probably bottomed out in this quarter. Anyways, they've not been as weak as expected. Asset quality continues to be good, and valuations, given the growth profile and from a historical perspective, also remain attractive. So, we have increased the component of the banking sector in our portfolios. Secondly, we've increased discretionary consumption. Autos is something which we believe will not only benefit from the GST cuts, but is a good growth story. So we've increased the exposure that we have to two-wheelers as well as four-wheelers. Fortunately, that has done well for us also. We are also bullish on the telecom space. So that is something wherein we've actually not made any changes. We've actually added on to our positions that we hold. We are also positive on the entire infra capex manufacturing story from a long term perspective. That is the other sector that we have added positions in. The cement space, Shailendra, in our view, is poised for a good recovery. We believe that margins over there have significant scope for expansion. And we are anyways entering a period of good construction and seasonality as far as the sector is concerned. And it is also likely to benefit from the ongoing consolidation that is happening in this space.
Okay. Sandip ji, it gladdens my heart no end to hear about cement. Trust me, for the last 2 years, we've been asking around with all sorts of peers and your friend group. Nobody is talking about cement at all at a time when valuations have, in the mid cap space, sort of harmonized. Even large cap is looking good. So, what has been your strategy? Are you going for the two large consolidators in the market, or are you looking at potential buyouts and therefore those targets make sense for ASK? What's the thought process at the cement space?
So, Shailendra, we have been buying cement names across the spectrum. We have large caps, mid caps, as well as small caps in our portfolio across different strategies as per the specific mandates that each strategy has. We have not gone into acquisition, potential acquisition targets and playing them. That has not been our strategy. Our focus has been more on those cement names wherein we believe that volume growth is likely to be good going forward, which could potentially be higher than what the overall industry is going to offer. That could be due to organic, or it could be due to the recent acquisitions that those companies might have made. Also, we are focused along with volume growth on margin expansion, and this margin expansion is primarily driven by the cost control initiatives that specific companies are undertaking. We do believe that margins are also going to expand because of pricing power that will come in the industry as the industry is becoming more consolidated. But our stock selection is more focused on those players that are tightening their belts. The last thing which we are factoring while selecting names in the sector is the regional mix. There are certain regions in the country wherein we believe growth could be higher or pricing power could be higher. And if names that have larger presence in those geographies, we are selecting them.
Right. Sandeep, there is also this, thought process running in some part of the investment circle that cement plants and companies close to Amravati, the new capital that's being formed down south, would be slightly better beneficiaries of rising demand. Are you in that group of investors, or does your existing investment philosophy take care of those as well?
So our existing investing philosophy actually takes care of that as well. Yes, the southern region could see good demand growth because of specific projects or large construction activities that could happen. Maybe smaller sized micro cap cement companies in that specific region could more specifically benefit from such kind of events, but we are more focused on slightly larger sized businesses. Will they also benefit from this? The answer is yes. And will that region offer better growth?
Correct.
than other parts of the country? Perhaps yes. And are we positioned to benefit from it? Yes, we are in our portfolios.
Wonderful. Sandeep ji, what has been the main learning in the last 12 months? What could have gone right for ASK investment managers? You may have missed that bus on the long side, or you may have, regretted not selling earlier. What's been something that sort of needles you over the last 1 year or so?
Oh, that's a wonderful question, Shailendra. Firstly, I think the overall slowdown that we saw in earnings, I think, and that getting reflected in valuations of a few companies, I think the slowdown, whenever it occurs at a unanticipated faster speed, and that also has an impact concurrently on valuations, and they can correct much faster and more sharply than one would have anticipated. So yes, the slowdown that came in earnings was something which was some kind of a surprise, though from a positive perspective we were not positioned or underweight in a few sectors wherein also earnings were not that great. So, examples would be sectors like the IT space, and also in a few sectors where we found valuations already to be heady and earnings were also not great. That also kind of helped us, let's say maybe something like the FMCG space. The auto space, the pickup that happened was quite good. We were lucky to participate in that, perhaps in the right time. One of the spaces where it has not done as well for us as expected was maybe the entire capex infra story so far. Uh, Maybe the activities on the ground in the last 1 year or so have been more tepid and muted. Government action now seems to be picking up. Uh, Also, in the interest rate environment is quite favorable. We have also seen a pickup in demand with all the rate cuts, whether it be on the GST side or the income tax side. The entire system does have good and ample liquidity, and we would expect government as well as the private sector to start to invest going forward, and hopefully that is going to work out there.
Fair point. I think these pitfalls, these small hurdles are all learning points in the broader investment journey. I'm sure ASK has absorbed all that it could. Sandeep ji, this has been a large cap rally. Look at how M&M, Bharti, Airtel, maybe Maruti as well, SBI in particular has gathered investor interest. Were you well positioned to take advantage of this uptick?
Fortunately, yes, Shailendra. We are overweight. We were overweight, and we continue to be overweight on the telecom space. We have significant exposures there. We are also well placed on the auto side, be it both two-wheelers as well as four-wheelers. We believe that the demand pickup over there will not only due to the GST cuts, it is also due to lower interest rates, lower inflation, which uh, leaves more money, discretionary money, in the hands of the consumers. Going forward in the next 1.5 years or so, we will also see the pay commission benefits being rolled out. That will also, in our view, going to continue to support demand. So yes, we have been placed well in the auto space. We continue with our overweight stance there. We've also liked, in addition to this, Shailendra, we've also liked some of the auto ancillary names. and that have also been beneficiaries.
Would you care to name them, the auto ancillaries?
Unfortunately, would not like to mention stock specific names. So if you could please excuse on that.
Okay. No, no worries. You know, you gave me a leading question. It would have been, you gave me a leading answer. It would have been my responsibility to ask for those names. You haven't named them, it's fine. Let's take this a little forward, Sandeep ji. What do you think is the missing piece in markets as of now? The government, on its part, Sandeep ji, has done everything. We have an interest rate cut, a GST rate cut, an income tax rate cut. We have higher liquidity in the broader market thanks to the RBI, and of course, you have a very good tailwind on the political side. Bihar is back with NDA. Let's hope that's true. And of course, generally the demeanor in the country is fairly okay. Why do you think markets are not accepting this? What do you think is the missing link?
A number of missing links, Shailendra. Firstly, I think there is this overhang of the trade deal not happening with the US so far. Most major economies have had an understanding which has been reached with the US. India is amongst the few large countries that remains. Maybe Brazil also remains. And anyways, the tariffs that have been put on us are quite punitive. So whenever that happens, I think it'll be a good relief for the markets. It's a big overhang. So that is one piece. The second thing is that the government had announced that the GST reforms that have happened is perhaps at the beginning. There are more reforms in the offing, more measures could be taken. We have seen some ordering on the defense side, but we are awaiting a more pickup in the overall government activity from an infra projects perspective, announcements, PLIs, whatever have you. The third piece which the markets would be looking for is the private sector capex cycle. That has been an expectation for a while. Maybe it was earlier to do with the government that is going to come at the center, maybe last year. This year it has so far been the overhang of the deal with the US. With the pickup in demand, with perhaps a trade deal, etc., being announced next year, next calendar year onwards, should we see some pickup given that already corporates have raised a lot of capital through QIBs, IPOs, and interest rate environment is also favorable. So that is something also which the markets would look for. One thing which seems to be falling in place was the concern on the urban slowdown. On the demand side, maybe the festive season has been good, and demand strength hopefully continues. So that is something which will perhaps get taken care of as we move forward as well. So yeah, so these are primarily the aspects which are the key focus points of the market.
Sandeep, did you actually, I mean, within the peer group, within your fund manager, coterie, is the absence of a trade deal such a big negative that four major positives are being overlooked by the market?
So I think it's more of an overhang. I think it's more of a sentiment aspect. If we look at the size of the trade that happens with the US, we export around 85, $86 billion or so. Estimates suggest that about half of it could perhaps get impacted. In terms of the overall impact on the GDP, it's going to be less than 1%. The impact that has happened so far has actually been much lesser. From an absolute fundamental perspective, is it a deal? Is it something which is very negative? The answer is no. But does it impact sentiments? Maybe yes, and especially because the kind of tariffs that have been put. Yes, it is more to do with sentiments. Also, Shailendra, what has happened is that during this time, earnings has also been weak. And As we see a pickup in earnings in the second half of the year, as we see growth coming through, I think markets will move forward, hopefully.
Okay. I think earnings is something that you highlight pretty well. This is, yes, the missing link that has been, contributing to this sideways to weak phase over the last 6 quarters or so. Within the third quarterly earnings that are upon us, Sandipji, what have been the green shoots uh, within your purchase basket? What are the companies, what are the sectors where green shoots have emerged further or strengthened in the numbers gone by?
We've seen good earnings delivery in specific pockets of consumer discretionary, whether it be autos, whether it be the jewelry space. I think not as much about the earnings that have been delivered. It is also to do with what is the management commentary and outlook going forward. I think in that segment, it continues to be positive. So that is something which is, we look forward to. The banking sector, there is a pickup in credit growth and loan growth. Margins have likely bottomed out. There will also be benefits of CRR cuts that will happen in the current quarter. So we do expect that sector also to do well going forward. Then, in addition to that, in a few segments of the capital goods infra kind of a basket, we've seen specific companies doing well. Over there, earning numbers, whether it be volumes or margins, have started to pick up, and we believe that it is going to gain strength going forward. As we discussed earlier as well, Shailendra, I think markets are going to become more stock specific wherever earnings delivery and continued earnings delivery, the visibility is there. Those are the spaces that we are focused on. In addition to whatever we discussed, I think markets were also not doing well. This is on your previous question because FIIs have also been relentless sellers. We saw some buying in the month of October. Maybe as the currency stabilizes, and for them, maybe the trade deal could be a bigger thing than for us from a sentiment perspective.
Yes, that's very well explained. Given the slightly nationalistic view that many American fund managers are taking as to what Mr. Trump is doing and how their portfolio should reflect the ground realities of politics in the US. Time is short, Sandeep ji. Given the positives that we've discussed in the market, how do you see the Nifty or the Sensex, say a year from now? Are we destined for higher trajectory given the tailwinds? Could something go wrong? What's the broader thought in your mind?
Valuations, Shailendra, are at about 21 times 1 year forward, which is at about the historical 10-year average levels. From here onwards, a reasonable expectation would be that earnings are going to compound. Earnings this year are likely to be in the 9 to 10% kind of range, but markets are going to be more focused on earnings for FY27. Earnings for FY27, various estimates are between 13 to 15%. Over the long term, we've seen that markets follow earnings, and that should be the broad construct as far as expectations are concerned. Could things go wrong? The answer is yes. There are always risks in markets, in investments, in equities. The risks which are out there on the horizon, as we discussed, if sentiments do not improve because of trade negotiations dragging on and these punitive tariffs continuing, if the demand pickup does not actually happen on the ground and just fizzles out after the festive season pickup that we've seen, or if we do not see any follow-through measures from the government, then could there be again a downgrade in earnings next year? Yes, the possibility then would arise.
Right. Sandip ji, it's always such a pleasure to get back listening to old friends, especially those who manage so much of money. Thank you for your time. And all of us are looking forward to a better 12 months after a very painful 1 year in hindsight. Let's hope Mr. Market listens and delivers what we are hoping for. Thank you for your time.
Thanks a lot for having me on the show, Shanit.
That, ladies and gentlemen, was Mr. Sandip Bansal, Deputy Chief Investment Officer at ASK Investment Managers, one of the oldest PMSs in the country. He's reflectively bullish, sees large caps outperforming, and of course the earnings cycle improving, and cement doing well from now on. Thank you for watching. Please stay glued to Business Today.